This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
This week, as we celebrate America's birthday, on the show we excoriate both political parties' economic approach. We talk about the difference between fiscal and monetary policy, their effects on the markets, of course, and then we talk about the new stock that we've recently added to the portfolio. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein. Happy birthday, America. We had a decent sum of influential data on this past shortened market week, but I think the most impactful news was from this ECB forum held in Portugal, which featured many of the global monetary policy experts, folks in actual positions of power that make monetary decisions. And it was highlighted by this panel discussion that featured Jerome Powell, the ECB president, Christine Lagarde, and Brazil's outgoing central bank chief, who's soon to be replaced by a pick from their newly reinstalled far-left president there. And all of them make a deliberate point of trying to avoid politics. All the questions seem to point to politics, and most of the responses are trying to avoid it. In fact, the Brazilian bank president, Roberto Campos Neto, I think that's how you say it, kept emphasizing that he uses a technical approach. He kept using that word, technical approach, meaning that they de-emphasize ideology. And Powell tried to lay down the law by saying, when he was asked about politics in these economic affairs, that the traditional answer, to some extent, is that fiscal policy is the job of elected people, and that the Fed handles monetary policy. Importantly, though, and in a lesson for all the politicians today, Powell criticized that right now we are running a huge deficit at a time when we're at basically full employment. The number ticked a little bit higher on Friday, but basically we're at full employment, still running this huge deficit, meaning that this is a time that we should be banking cash, that we should be saving up, not still running tremendous deficits, because it doesn't get better than this. It's only going to get worse if we get to a time when we have a softer economy, higher unemployment. That's when you run massive deficits. So he goes on to say, and this is Powell's words, he said, the level of debt is not unsustainable, but that the path that we're on is unsustainable. And he's trying to be careful and says as much because he doesn't want to be publicly political, especially in a general election year, but likely also because neither presidential candidate's messaging or policy stances do anything to address this. The truth is the economy is in a pretty good place right now. It's showing signs of softening, but that's what you expect if you are going to hope for a soft landing. And you would be mistaken to give any political or any particular political maneuvers the credit or the blame for what is overall happening, although they do have a measurable impact in many ways. But no politician, no controlling party has a binary effect that turns the economy good or bad. They can certainly juice it up and then incur the costs for, spiking the economy that way, which is kind of what Powell is saying here. We are in a very strong position right now, but we're still adding the costs of juicing the economy further instead of saving for that rainy day. But it's not all good or bad, depending on what happens in November, except despite honest intentions to be, let's say, apolitical on this show, we do try to give an honest opinion on what's sometimes jokingly called the science of economics. But a lot of the policies, at least those being sold to the general public right now, by both and by most candidates, a lot of those policies, deliberately, of course, resonate with the hearts and the limited minds of the average voter, but they don't do much to support the continued growth, and they certainly don't do squat about the debt and the deficit. But as we move back to that panel discussion, they went on to talk about the R star, or the neutral rate. Because right now, at least in the United States, interest rates are well above the neutral rate. That's the rate at which monetary policy interest rates are neither helping nor hurting the economy. They're not trying to help employment. They're not trying to fight inflation. Right now, we're well above it, meaning we're trying to fight inflation at the cost potentially of employment. But Powell pointed out that the big question now, which they do discuss internally at the Fed, and Christine Lagarde was there nodding in strong agreement. In fact, later on went on to say it's a description which she would, quote, perfectly subscribe to, but is that we don't know if that rate, that neutral rate, which undoubtedly we're higher than today, we don't know that the rate is fighting inflation. We don't know, he says, if that neutral rate today is back at near zero rates of the last decade, right? We're supposedly at neutral, but the interest rates were basically zero. Or if the neutral rate, the R-star rate, is somewhere between that and where we are today, saying that at 5+% Fed rates, we're above it, but that the neutral rate may not be that far below. Of course, that neutral rate shifts. It's not fixed, but I think a good baseline assumption, since inflation is only gradually ticking lower and unemployment is really not going up very much, well, if the neutral rate is flying the plane level in this economic discussion, and right now we're leveling off for the soft landing, well, I think it's logical that we are a lot closer to that neutral rate here, where both are close to even, than we would be if the Fed rate was 4 to 5% lower. So while this is all very imperfect and subject to change, especially in reaction to major events that require dramatic action, but I think it's fair to expect that the benchmark rates and that all that they bring are closer to where we are now and where they've historically been since World War II than where they were over the last decade. And that too then brings a stronger dollar, but also a much higher cost of borrowing. It brings mortgages, which may not remain at 7+%, but you won't likely see mortgage rates below 3% again anytime soon. Maybe not in my lifetime. It will bring a much higher cost or a portion of the total budget of paying the federal debt. And it will mean that the leverage that corporations have to pay more of their revenues to pay their debt. It means lower dividends and lower margins and lower dividend growth for especially the more older, established, traditional American companies. And it means that it will continue to cost more for houses. If the supply of houses ever does start to meet demand, and this is and it will be more of a regional issue as the supply of new homes catches up and some communities are more vibrant and have more space to build. But as boomers do give up their homes to the supply, despite them clinging to their cheap mortgages today, if that supply can start to meet demand, and if mortgages are 6 or 7%, so you got more supply, but mortgages remaining high, then housing prices have to soften. Again, back at that same conference, separate from that panel discussion, we got to hear from the Chicago Fed president, Austin Goolsbee, and he said that goods inflation, what you're paying for goods, it's basically right where it was before the pandemic, at about -1%. You're actually paying less for goods today than you did a year ago. Not cheap, because we're not going really back hard, but goods inflation is negative. Service inflation is higher, but services inflation is about 2.5%. And the whole piece that's yet to be solved is the cost of housing. And while I just finished describing or alluding to some reasons why housing or houses are staying expensive, basically it's all comes down to a lack of supply, and just leave it at that. The rents across America have been coming down, and you can see it in the pipeline, such that it's this readable data point, but it's one that doesn't yet show up in the core inflation reports, which is why guys like Goolsbee are getting more confident, as he went on to say that the pickup inflation earlier this year, which kind of spooked us all a bit, well, that quote looks more and more like it was just a blip, end quote. And he went on agreeing with those three panelists from earlier that in the U.S., a year from now, the headline PCE number, that kind of central measure of inflation, He says it'll be in the mid to low 2% area, and sustainable, but below 2.5% would be a, quote, great outcome. Going away from the conference, though, back to our friends at Securities, they say that, quote, the backdrop here, where we are now, they published it this week, where the U.S. economic data may be slowing but is not overly worrisome. There are some cracks, but not big cracks. I'm paraphrasing a bit for your sake here. U.S. initial jobless claims ticked slightly lower last week. Separate from Securities, they ticked a little higher this Friday on the July 5th. But they say anything above 260,000 new claims would raise their antenna, but so far they're not there. Basically, we are in good shape for the soft landing as far as they could tell. Meanwhile, Tuesday this week, we got the JOLTS jobs opening report for May. This is not unemployment. This is how many jobs are available. And there are almost 8.2 million available jobs in the country right now, 200,000 more over the estimate, and 200,000 jobs more than in the April report. So if the jobless rates are showing a bit of softness, there are available jobs out there, but of course, they don't always match up perfectly. You have different jobs for different skill sets, and of course, sometimes people have to move about. There's a geographic limitation there. Still, the recipe is largely in place for a benign economy for the near future. The risks are to the downside, and we got an ISM reading on Wednesday that was in contraction territory as big companies in that data point, big corporations were pulling back big time on new orders. And we are looking at maybe a period of some corporate austerity, which could define the second half of this year as we lead towards the election. On the other hand, if you strip out the oversized handful of kind of gaga stocks that have dominated the S&P this year, the returns and more importantly, the valuations are much more muted, pricing in a slower period ahead. So there's some room for error and there is value lurking there. And I'm going to get into that in a moment after I take a quick break here, because I'm going to come back with a new position that we've just added to the portfolio. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Will the Magnificent Seven continue their spectacular run? Be careful relying too much on last year's playbook. Tune in every week to hear Simon Hamilton and Chase Hinderstein discuss the latest financial trends and what investors need to know. To learn more about some of the most important planning topics to consider and how to become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
All right, welcome back to the show. Beyond all that Fed talk, if you are still awake out there, a lot of the narrative around the markets today is kind of two juxtaposing thoughts. One, about 70% of the stocks in the S&P 500 are underperforming the index today. In fact, a good deal of those are negative for the year. And that's a ratio that is really rare in history. Some take this to mean that the upcoming year or more doesn't bode well for the markets. But the other narrative right now is that if you strip out this Magnificent Seven or you strip out the high-flying AI names, depending on what you strip out, the valuation on the market is actually far more reasonable, which may be obvious if you strip them out. But depending on how much you do strip out, we could be looking at a market that's offering a majority of the companies in this country at an average of 16 times or less earnings, with the majority of those names trading below their 10-year average multiple to earnings. So that argument would support that individual stock picking and looking for value beyond what's worked lately may provide superior returns and protect against what may come next to some degree. If we do see these companies and you are able to buy them below their average historical norms, and then we actually see a good or improving outcome, basically you see earnings outperforming their expectations over the next year or 2 years. We have time to wait if you're really buying these cheaply. Well, that's where value is found. And with that today, I'm going to talk about a new name which we just started adding to the portfolio, and we did so with a very modest position, a position which we expect to expand on over time because we don't know if this is the bottom. We want to average in and own this great name over a long time, I expect. It's a dominant global brand that's just getting whacked pretty good this year, especially recently. And before I get into it, I'll point out that, as you know, if I like it here, I own shares in it. And as I said, we're buying it for our clients. So I'll have some negative things to share about it today. But regardless, I have a positive bias towards this name. So caveat emptor. But this past week, we started buying a position in Nike. If you don't know what Nike is, well, I don't know where you've been, but it's a name which we've coveted for years. And I guess we've largely benefited from not buying it over the last few years because it's been completely sucking wind lately. And the stock is now down 30% this year. That's based largely on a sell-off after they reported their fourth quarter results, since they're not on the traditional calendar, so they just repeated their fourth quarter. But they beat on earnings, but they gave pretty guidance for the next few quarters. And that's in the face of the Olympics coming out this month, which brings a lot of attention to the brand and gets some people running. But to start off with a source that's been negative on the name, I'm going to use Raymond James, our parent company. They downgraded the stock to neutral, citing this guidance, which they say was due to worsening global macro headwinds, including volatility in China and a hit from foreign exchange, as Nike sells more than half of their products get sold outside the U.S. And as you see a stronger dollar, well, that actually weakens margins when you're actually trying to sell goods into foreign lands. A lot of the street is down on the stock right now, but looking at the consensus estimates on FactSet, we see that the lowered combined guidance for the company, it's already been lowered. It factors in terrible reports we saw recently. Well, they expect the company to deliver over 20% in free cash flow over the course of the next 4 years combined. And that's why we're hunting for value here, albeit cautiously. Nike is now trading at a historically low multiple to those already lowered forecasts. And, there are definitely risks to the downside. The consumer could really get uglier, and that wouldn't do well for Nike. But that's why we nibble as we look for value. There's also a chance that management's innovation attempts, the Olympics, and this kind of general global expansion lifts these lowered expectations, these estimates, and that Nike then levers to those results with a more normal rating and a more normal multiple. And it's proven to be a really cheap purchase here. As today, it is now trading at a more than 10-year multiple to its own earnings forecast and versus the market multiples. And I wasn't, unfortunately, able to go back more than a decade on that. So it's at least a 10-year low multiple to earnings. Over at Goldman Sachs, they're standing by the pick. They actually reiterated their buy rating and a $105 price target, which is almost 40% higher than it is today. They too pointed out the same disappointments in the current quarter and the guidance. However, they went on to say that, quote, "We are constructive on the company's accelerating multi-year innovation cycle," end quote. Nike right now is struggling and seeing sales fall off in their lifestyle brands. They're actually seeing accelerating sales in their performance brands. And there's a lot of competition out there for folks who want to lounge about in sporty type clothes. Right now I'm wearing a competitor's so-called running sneaker, but I'm wearing them in the office as a casual shoe. And you'll see them everywhere. But Nike is still doing well and acting as a leader in the performance gear. That's the gear you actually buy to do some kind of sport in, as opposed to the lounging about stuff. Now, Nike is releasing a line of sneakers that costs less than $100, but their signature Air Jordans now cost $200. And I think that's remarkable because I hear parents and friends of mine who are parents complain about Jordans costing $200, but I looked it up. And in 1988, Air Jordans were $100. So in my mind, $200 is a relative bargain today. The regular inflated price of that sneaker from 1988 to today should be about $300. So maybe Nike should be raising the price on their Jordans. Goldman also went on to list any China slowdown as a possible risk to their calculations, as China is about 15% of their sales right now. But that exposure is largely limited, albeit not unique, in our portfolio. So in the same sense, it's given us a little bit of exposure to that Chinese consumer in an out-of-favor time and maybe could offer some better returns going forward. Another trend that needs to reverse, but I guess I'll have faith because over the course of the last 40 years, it has always come back in the cycle, is that American teenagers need to rediscover and embrace Nikes and Jordans again. You know, they're not completely abandoned today, but they've been overtaken by a brand that instead takes pride in being particularly an ugly shoe. But that's a fad that is probably not going to last forever. It's just a question of Nike can take it back and when they can take it back to get more of the American share. In the end, the investment thesis is that this is a leading global brand that's completely out of favor right now, and because of that, unusually cheap relative to where it typically trades. Per JP Morgan report, and they too were negative on the stock, they point out that Nike is, quote, playing the long game, end quote, as they sacrifice some near-term margins by investing in marketing around the Euro Cup, the Olympics, and increasing visibility across the world in women's sports. The timing is what's at stake here. The results in those efforts is likely to deliver better sales over that long game, and that's why one builds into a position in something that's currently out of favor. Today, you could buy Nike shares for as cheap as they've been since the low points of the March 2020 COVID sell-off. And if you eliminate that brief couple of months there, the share price on Nike now is as cheap as it's been since 2018, here in the low 70s. Value Line hasn't actually re-rated them since this sell-off in June, but in their April report, they wisely had a low earnings predictability rating, and they dropped it in their timeliness scale, but also said, quote, conversely, a drop in price of more than 10% has resulted in above average capital appreciation potential for 2027 through 2029, which they say when the stock, they said this all when the stock was 90. So $20 cheaper, we just have to assume that they'd be even more favorable if they stick to that estimate, which is what, for what it's worth, they went on to say that the dividend should rise by more than 10% per year and that will help support return. But that they went on in that April report to say the yield is not much, it was subpar, but at these depressed prices now, the stock's yielding a little over 2%, compounding at 10% a year. Anyway, they go on to emphasize that the swoosh will be everywhere at the Olympics this summer. I can't remember when the Olympics qualifying events got as much attention as they did this past month. But as I wrap this up and I get ready to celebrate the 4th myself, I look forward to seeing our American athletes doing really well over there in Paris. So good luck to them. That's it for me this week. Happy 248th birthday, America. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.